Hey there, YouTube. Today we're going to talk about the butterfly spread, a long butterfly spread for a 0 DTE. Now, before you discount a 0 DTE, it actually has some merit. A lot of times stocks stay within a certain range, and as long as there's no news event, no catalyst, stocks will stay in a certain range, and you can profit off the very fast time decay that you get on a 0 DTE. That's what makes these kind of nice to work with. I'm going to show how to set it up, the maximum profit, the maximum risk, and your takeout points, how to get in, get out. We're going to go through all those calculations. We're going to also show you how to do this in Thinkorswim, how to set up the trade, and how to set up limit orders to get in, get out, and then move on to the next trade. All right, so with that, let's just jump right in. First, what you're looking at here is a profit diagram. You have the zero line here. You have your maximum profit here. The zero line is the stock price. If you were to look at the stock and lay a stock chart down on its side, this is what it looks like. So you might have something that looks like 60, let's say we're trading SPX. We'll use SPX for this example. You might have that at 6,200 and this is 60, call it 6,400. That's this point and this point. The middle here, we're going to set up for this example is 62.75. Okay, so this piece here is considered at the money. And when you're trading these legs, it's important to know what piece we're talking about. So your at the money is where the stock price is currently trading. You're going to trade an options contract at the money. This part here, this is your considered deep in the money. The further down you go would be deep in the money. A couple of strikes in the money would be just in the money. So this is your in the money, and this will be 62.45. This is the stock price, and out of the money would be 63.05. We're going to set this up to where it's 30 wide. I'll show you in Thinkorswim how to determine the best width to pick. But when I say 30 wide, I'm just talking about what's the difference between the at the money and the out of the money or at the money, in the money. It's the width of this part of the triangle. All right, so the prices would look like this. Now, I have an options contract here. There'll be one here, two here, and one here. And these two are actually short. This consists of if you were to break apart the butterfly, it's really just a bull call spread and a bear call spread combined. And it looks like this, 62.45, 62.45. This is just one of these. 62.75, two shorts, and 63.05, which is one long. And what the prices might look like when you're setting this up is this one might be 41.75. Prices will vary depending on the volatility. 62.75 would be going for maybe 20, and 63.05 would be selling 600. Since I've got one of these, this is 4,100. This is 4,000 because I've got two of these. So that's 4,000 as a credit. And then I got 600. So what I'm left with is when I look at the sum of all of this, you've got 4,175 minus 4,000 is 175 plus 600. So we're looking at $775 for this spread. That's all this thing's going to cost us to enter this particular trade. So our maximum risk is this part here, 775 here. So if the stock closes anywhere below 62.45 and anywhere above 63.05, our maximum risk is $775. That's what I like about the long butterfly spread is you go in, and when you enter it, you know what your risk is up front. There are no hidden surprises. It is what it is. You pay for it. That's the maximum risk. Now you could just set it and forget it and see where it closes at the end of the day. That's a little bit risky. What I like to do is set it, establish it, and then set a takeout point of 50% or 25%. Maximum profit is 62.75 minus 62.45. So you take your at the money minus your in the money. So take the width of that, which is 30, minus 775. 775 is 22.25. So this point right here at the end of the day would be worth 22.25 times 100 because we're dealing with contracts of 100. So it'd be worth 2,200 bucks if you wait to the end of the day. That's great and all, but what are the odds that it's going to close exactly at 62.75? Very slim. So you set a takeout point. Let me get rid of some of this here. Another thing I want to show is the graph. Get your head wrapped around. This blue, this is time. This is, let's say it's 8:30 in the morning Central. This is 4 in the afternoon. And this is 6,200 here and 6,400 here. Let's say the stock opens up here. At 8:30 in the morning, it might do a lot of this, depending on what kind of news happened over the night. But let's say it starts coalescing around here. All this blue is the same thing as looking at it on its side, okay? So what we're looking for the stock to do, once we establish it, is to stay within this range. If it stays within that range, we become profitable. If it drops outside of this range, or drops here, goes up here, and then coalesces, we're going to be at a negative. If it does this right away after entry, you're going to be a little bit negative, but maybe not a lot because time decay hasn't set in yet. The longer it stays out here, the more time decay sets in, and the more you're going to set up for a loss. A lot of times those stocks will pop up like this, coalesce, and maybe they'll drop back down. And if they drop back down, take your profit. That's the whole goal, is just make sure that it stays within this range. And if it goes outside this range, then maybe you instead of taking your 775 loss, maybe you decide, I only want to lose half that. And then when it hits that spot, set a stop order and get out of it at 350. If the price stays within this range and you become 25 to 50% profitable, I'm going to set my limit order to 50% of this. So let's just, for easy numbers, round it up to $8. I'm going to set my limit order for 12 and I'll make 400 bucks. In this case, $425. And that's if I wanted to wait for a little bit longer, take a little bit more risk by waiting, because anything can happen during the middle of the day. Somebody could say something, a Fed speaker could say something, and the stock just all of a sudden drops. So a lot of times people will set their profit at 25%. So take it out instead of $8, they'll take it out at $10, take their $200 and run. A lot of times if the stock stays within this range in the first couple hours, you can get that within an hour or two. So that's another thing I like about this strategy. Now, if you wait a little bit longer, you also take the risk that it goes out, pops out up here or pops down here, and then you're hoping that it comes back in. In part 2 of this video, I am going to show how to roll your risk up or down. So let's say it does pop out here. I can cancel out this part of the risk. Or if I'm looking at this chart, I can cancel this part out. And then I can open up another strategy that would profit and hopefully take away some of this risk and establish maybe another butterfly or something, or do another thing. And I'll get into that in part 2. All right. One other thing too, when you're looking at the width, this is the only math nerdy thing I'm going to do today. Taking a look at this width, this is the expected move for the day. That is calculated simply as a function of volatility. So your expected move is really just your stock price times the implied volatility multiplied by the square root of time. Well, that at any day, I can go look at the implied volatility and I can tell you what the market is expecting the stock to move. Based on options pricing, based on all known factors, this is what we think the stock will stay in. 68% of the time, it stays within that range. However, there are a lot of times that the stock will pop. There's some news event that they weren't counting on. In fact, most of the time, news events are accounted for. It's when there's a surprise that pops up that the stock then will bounce up or down. And so there's kind of ways to get out of that or hedge your way out of that or minimize your loss. But that's about the most nerdy thing I'm going to do today, is to show you that formula. You can do this on any stock, any index, and it works. But the good thing is Thinkorswim actually shows how to calculate that. And in fact, it already has the number for you, so you don't even have to calculate it. And then that tells you what you should put your out of the money and in the money, how wide you should make this based on this right here. For the purpose of the video, I'm just using 30 wide. Sometimes it'll be 40 wide if volatility is higher, or if volatility is really low, it might only be 20 wide or 25 wide. And what I'm doing there is I'm setting up my width, which is my risk for the amount of profit I'm going to make, because I can go super wide, but the profit I'm going to make is just going to get narrower and narrower. But again, just set it up for 30 wide, get the hang of it, trade it your paper account, get used to it, see what that looks like. All right, so with that, I'm going to jump into Thinkorswim and show you how to set it up. All right, so here's Thinkorswim. I've got, if you notice at the top here, I've got ES futures. This is representative of the index. It is before market opens, so I'm not showing the index. 2 of these contracts represents 1 SPX. You can also trade this on SPY, which will be a much smaller position. 2 ES contracts represents 10 SPY contracts. So if you have a smaller account and you want to just play with this, trade it on SPY, it's a tenth of my loss and my maximum profit, what you're seeing there. So instead of $775 maximum loss, if I trade an SPY contract, just one position, it'll be a $77 loss. Or my maximum profit was what, $2,200? My maximum profit would be $220. So SPY might be a good one to start with. And then as you get the hang of it, move up to SPX, which is the equivalent of 10 SPY contracts. ESU, 1 of these is the equivalent of 5 SPY contracts. So I like to just keep things simple and just trade 2. So you'll see my defaults are set to 2. All right, so this morning, we're waiting for the jobs report to come out. It's been coalescing around 62.78. Let's say 62.78 was coalescing there at 8:45 or 8:50, 8:55 in the morning. The market for me opens at 8:30. So let's say it's 20 minutes after open. It's coalescing here. I'm going to open up a position. So in our example online, we saw it was 62.75 was our at the money. These are at the money, 62.75 or 62.80. It's just the price, and then the strike price is where we're at. So for the purpose of the video, I could say 62.75 or 62.80, depending on maybe I think, bounced up a little bit, whatever, it doesn't matter. So I'm going to select that one. I'm going to go down 3 wide, right? We talked about that. So 62.75 minus 30, not 3 wide, 30 wide, 62.45, and then I'm going to go up to 62 or 63.05. These prices are reflective of the volatility for today. Sometimes they'll be a lot cheaper. When these are cheaper, though, the position itself is more expensive. A little weird, I know, but it's the way it works. It's a function of volatility. Here's the volatility number. Remember that formula I showed you a minute ago? There it is. 13.808% is the implied volatility. If you do the math on that, based on how much time is left for today, the expected move is 35. So if that's 35, I'm going to trade about a 30 wide. If it's 25, I'm going to trade about a 20 wide. If it's 45, I'm going to do about a 40 wide. You get the idea. I'm going to trade my width somewhere around my implied volatility expected move, because I want to stay within that expected move. And I also want to not take on any more risk than I have to. All right, so I've got 2 of these, 2 of these, 2 of these by default, but I've got to sell 2. Remember our calculation earlier, we have to have twice as many of those as we do the longs. So these are my longs. These are my short. This is my short. So I'm selling twice as many. Click next, and there's my price. I think our price when we did the example was $7.75 based on current volatility. Looks like it might be getting a hair more expensive. It was as expected. The jobs report's going to be published here in about an hour. And so I'm going to lock that in. And let's see, let me look at my bid ask up here. Whoops. Somewhere between 715 and 905. So I could definitely buy it for 905 because somebody's selling it to me at that. I don't want that. I can ask as 730. It's not going to execute at 730. You can see here, this is what I'm looking at here. Okay, so I'm going to set my order somewhere in between. So I could set it for 775. There it is. Here is the chart profit diagram doesn't really work on futures that well. So I go to the table. There's my maximum profit that we calculated earlier, my break-even points, and what's my maximum loss. So if this order gets executed and it goes way south or way north, doesn't matter. I'm only going to lose $775 all in. And then I'm going to set my takeout point once I execute this. So let's go ahead and execute. All right. So I'm going to execute the order, $775 plus my trading cost is $793. It's a maximum that I'm going to take, my maximum risk, because I did not calculate the trading cost in that earlier. So let's execute that and see if it took. There's my order, still working. For the purpose of the video, I'm going to lower the price. I'm going to increase the price because I want this thing to execute so I can show you how to get out of it. Okay, it's still not executing because I'm too cheap. Okay, so I got an ask of 880. So if I go closer I get to 880, the more likely that it is that's going to sell or close, and there it executed. So I can see my filled order, go back to my positions, and I'm already $35 profitable. Now, it wouldn't be worth it to take that trade, go ahead and close it because I got $18 worth of expense just to open it, another 18 to close it, so I haven't really made anything yet. All right, so there it is. I'm going to select the whole entire thing, click close, sell butterfly, close, and I'm going to set my profit target to, let's say, $10. That's my 25% mark. And get in, get out, and make a couple $100. And that's it.